Now, individual stock valuations have been collectively tied to macroeconomic developments and specifically the actions of central banks. Since the collapse of Lehman Brothers in 2008, Eugene Goosen from Ora Funds says there are signs that this correlation is about to come to an end. He now joins us from our Cape Town studio to explain why. Eugene, I would imagine the two events that we're tying together here, the break in the correlation as well as, of course, Lehman Brothers back way in 2008, suggest that something has happened that has broken that relationship. And I would hazard to suggest that perhaps is that to do with the lessening of the global risk environment?
Yeah, absolutely. Hi. I think what we are seeing is that the market has been driven by global top-down macro factors over the past 3-4 years. Correlation between asset classes has been very high, and I think we're slowly but surely getting into a state where the risk on risk off scenarios are being applied less and less and less, and people are starting to focus on underlying assets. I mean, what we have seen over the past year or so is that typically the equity play was people would prefer to be invested in defensive stocks, not cyclical stocks, and it's a way of hedging yourself. What we are now seeing is that analysts are starting to focus on the underlying stock and the underlying stock's cash flows instead of the macro factor drivers on the broad stock exchange.
Yeah.
So if we look at the correlation between various asset classes, we're slowly starting to see a normalization, and that is the long-term trend that, for instance, if the currency behave in a certain manner, that certain asset classes would correlate highly and some will correlate less, or interest rates and equities might not correlate that much. And bottom-up stock picking is becoming more and more the norm, and it will pan out over the next year, 2 or 3, to be the driver of especially equity returns.
Yeah. Should we read in that, Eugene, that perhaps therefore that means that the risk that was evident at the time of the collapse of Lehman Brothers is now less, and therefore we are beginning to get into normal territory again? And yet when you look all around, the numbers that you read appear still to be dismal. Are we out of the woods?
No, not at all. We're not going to be out of the woods for the next 5 years odd. What we are seeing now is at least some form of stabilization in Europe. I think the numbers that the German government just put out in terms of their GDP forecast for the year is in the area of 0.4% expected growth. So they are still in a dismal position. But what we are seeing is that the patches that were applied to the European economies seem to be working, and it seems to be stable, and it's going to take a very, very long time for the wounds to heal in that economy. If we look at the US economy, things is working much better. It's not great, but it's substantially better. We're seeing the housing market normalizing to some extent. We're seeing house prices starting to escalate. We have seen home builders in the United States rallying very aggressively. So the US economy, to some extent over the next 2 to 3 years, is moving towards a more normalized, I would say, average trend growth economy, but they still got serious problems that needs to be solved. And then lastly, Asia, there was a bit of a scare, especially from China in the middle of last year, where growth started deteriorating. I think the short to medium term story on China looks reasonably good. I think the stimulus plans that was put in place is working. So over the next 5 or 10 years, that story might change, but over the short to medium term, things looks much better. And if that's the case, you don't get the sudden swing of cash in and out of US treasuries. We're slowly going to see asset allocation moving more and more towards equities, especially if you look at your international markets. Your dividend yields there is similar to what you get on bonds, so the guys might as well go the equity route. And in the local market, I believe this asset allocation towards equities more and more will support our market, but will also force people to start doing more selective stock picking instead of just buying an index or buying an asset class.
Eugene, I just wanted to tie this in with what we were discussing with your first point about how the individual stock valuations were decoupling from the macroeconomic forces at play. Is part of the reason you're seeing money leaving fixed income portfolios, and I think you, on our phone call yesterday, identified emerging market equities as the beneficiary of those funds. Is that part of the reason why? Part of the reason why that's happening has to do with the decoupling of this macro economic influence on the valuations.
Yeah, I think what I'm saying is what we're seeing is that your macro environment is normalizing. In other words, the way company earnings should materialize over the next 3 to 5 years should be in a more normalized environment. So it's not that people will simply buy bonds as an asset class or buy equities when they want to add risk. They feel more comfortable, they see a growth potential evolving, and that will cause them to move into equities as an asset class. But then because you're in a more normal environment, you're going to start selecting more selectively the asset classes, but drilling down to the underlying stock specifically, because not everything is as rosy in each and every counter. I mean, if you just look at the platinum sector, and let's compare Amplats and Implats, huge difference between the two, and people are starting to focus on that now.
Just in terms of some of the other, I think just to put this into layman's perspectives, when you talk about this risk on, risk off, or you talk about this decoupling that we've mentioned, obviously to me it means there's less risk on, risk off trade where you see the rand blow out and then come back, and the corresponding opposite move in the equity market or the bond market. What are some of the other things? Do you think it's going to be easier for traders and investors to make money going forward, or what exactly does it imply with this decoupling that you've been talking about?
I think it's going to be very difficult to make money going forward. I think you will most probably, from an asset class point of view, have less and less volatility. And we're seeing it in the VIX indices and risk indicators, that volatility within the equity markets or in the broader asset markets has come down substantially. Your trading patterns, well, I'm a long-term investor, so my trading mindset would be longer term than what it was, say, 6 months ago. What we tend to have in the broader investment community is that in this risk on, risk off scenario, or this more high volatility, high risk environment, is that people will take a view, they'll implement it, they'll keep it there for a couple of weeks or a month or two, and they'll take it away as soon as there's some extreme risk popping up. Let's say you've got a new Spain popping up or something like that. What we're seeing now is that your extreme risks are less. We do not expect another European pop-up to create uneasiness in the market. Although you've got to look at the more systematic potential risks. I mean, Iran is still there and Cyprus is brewing in Europe, but everyone feel reasonably comfortable. And because of that, you can lengthen the investment time horizon, which will enable people to start drilling down the asset universe into assets that will give them superior returns. You can't just simply buy index anymore. So I think returns is not going to be as simple as it was a year ago.
Yeah, so we're beginning to see some money leaving fixed income portfolios and flowing to emerging market equities. Now, we do know that the broad market last year actually misread the investment environment, and a lot of the fund managers did not put money into equities, and yet equities globally outperformed fixed income. How possible is it that perhaps people are misreading the situation again, and we could well see a reversal where bonds, on the other hand, outperform equities?
Well, it's not impossible, but if you look at global mutual fund flows, you're still seeing substantial inflows into fixed interest funds, but you're seeing more and more inflows being allocated towards equity funds. And it's not necessarily just the emerging market, it's equity in general. And I think the market in general is underweight equity. I'm talking from a global perspective. And even though equities have rallied, if you look at the potential for economic growth over the next 2 to 3 years, you're seeing the global environment correcting more and more. So we don't expect global growth to shoot the lights out this year, but next year will be better. We expect, for instance, the United States to return to trend or very close to trend growth in 2014. So the result is earnings will start adjusting for the accelerated growth, say 12 months after that. So I think the slow migration into more risky assets is definitely going to accelerate, and I think that's going to underpin. I think one of the big stories is that everyone say, yeah, but you're reaching an all-time high on the index. But if we look at valuations, international valuations take the S&P 500 as a very good broad proxy, valuations is not demanding there at all. In our local market, I think the market is fairly priced in some areas, cheapish maybe in the more cyclical areas, and fairly expensive in the defensive areas. So that's where your stock picking is going to come in. And we saw, for instance, yesterday how a bit of bad news from Shoprite Checkers just turned into a sell-off of, for instance, the retail shares. And then in December, we saw the sudden rally in the platinum shares. And I think we're going to see a lot of that, is where people see some overvaluations, they're going to cut it, they will move aggressively into stocks that were not the darlings and seek out performance there.
Eugene, just very briefly, and we've only got a minute left before we need to leave you, but I just wanted to bring it back into South Africa, the South African context. You're a macro top-down investor. What are some of the decisions you've been making around the portfolios you manage locally?
Yeah, I think the big South African issue now is the social political issues that we are seeing, that we've seen over the past couple of months, and how that's going to pan out from a macro point of view. If you look at underlying companies, do I place a discount on companies that, for instance, got huge low-skilled labor forces because of the risk of strike action?
Yeah.
But in general, I think the economic environment in pockets is improving more and more. However, if we get issues like Amplats expanding again, it's going to create a problem, and it will definitely put a lid on the market. So we will stay a little bit more defensive and rotate into your more cyclical stocks very selectively. So we'll rather use the diversified mining stocks than going on the direct way.